Coming up, Tom and Scott take on their 3 favorite stocks to trade, how to scalp the markets, the CEO secretary salary gap, your calls, and we end with a look at today's markets. Our first letter is from Jim, and he asks, what are your 3 favorite stocks to trade and why? Thanks, Jim.
Now come on, Jim. This all boils down to what's going on, what's the flavor of the week, the month, the trade. I will tell you the 3 most popular, I'll give you the 2 most popular stocks to trade, and this never changes, stocks, not indexes. The 2 most popular stocks for the last couple of years have been Tesla and Nvidia. That's where all the volume goes in the equity marketplace. Now there are a couple that pop up from time to time. There's lots of different ETFs and indexes that are in the top 5 and things like that, including SPY and a bunch of inverse ETFs and all this other stuff. But my favorite 3 stocks to trade lately, and this may be, it's not controversial, but this is kind of where it reflects most of my volume. I would say SLV, because we're talking equities and these are ETFs, SLV, GLD, and not in a good way, MU. Micron. So Micron Technology. Now today, the only stock that I've traded really actively this morning is Oracle, because I put on a bunch of earnings trades for after the close today. So, it's weird. I don't normally trade a lot of Oracle, but I did this morning. I just sold a bunch of puts. So we'll see what happens.
That didn't work out so well for you the last time on the upside, though.
It didn't work out. Oracle effed me to the upside, and now it'll probably F me to the downside.
So, Jim, to my comment is exactly what Tom's saying. It's the soup du jour, the flavor du jour. And, so it's what's active. I had to think about this, and I went back, and last year, for sure, NVIDIA for me, not Tesla, but NVIDIA for me, Apple, and if I'm going to throw a third one in there, probably Microsoft. But it's all, for me, it's all about just how I feel trading something and if I'm syncing up with it. There are certain stocks like Google, for some reason, I always feel like I'm pushing on a string when I trade Google. It's really liquid. It's a good stock to trade, the options. But I just feel like I'm pushing on a string there. Micron has been good, but Micron moves.
And it's got crappy markets. It's up 17
Kind of
bars
crappy
today.
markets, and it moves. But there's something a little bit intoxicating about that stock for me. So I was trading that a fair amount, towards the end of last year and this year. But again, it's what's active today, and what happened yesterday really does not matter.
Anyway, I'm Tom. He's Scott. She's Sol. And if you have any questions you want to call in, this is a call-in show. This is answer any questions you have on anything in the world. Nothing's off limits. Or you can type it in your questions to the dog pound. 989 Lossdog. Don't be shy. No small talk today.
Oh, right.
Right.
Did you
Scott,
get the memo,
no small
Scott?
talk. You didn't get the memo. Let's go.
Via screaming at me. Anyway, Tom
Am
is
I
always
being,
talking.
am I being scolded?
No, we're just helping you.
He already
We're
scolded me.
helping your online
But
presence.
he said, I'm going
Thank
to
you.
talk to him. He scolded me. But anyway, moving on.
I did not scold you. That's not scolding.
Okay. Tom is always talking about scalping every asset imaginable. How about a Tom's Guide to Scalping segment? That would be absolutely fantastic, says our friend Jessica.
Jessica, I did that like about 10 years ago, and it still got feedback for like straight 10 years. I really like. I guess I came in this business as kind of a scalper, and that was 40 some odd years ago, and nothing's ever changed for me. So, yeah, I like scalping every asset imaginable if it's scalpable. I mean, sometimes you find something that's not really scalpable, but I think, Scott, everything we trade is pretty much scalpable. If it's listed, it's scalpable.
If it's listed as scalpable, clearly liquidity
Yeah, I
differs.
mean,
Right.
you can
You
scalp.
just
You can scalp sports betting now if you want to, but you can pretty much scalp everything. We should do a segment on scalping because one of the things that people get very confused about scalping is it's kind of when to take profits and or how to measure like some how to measure some aspect of taking profits. Versus taking losses is usually something that's pretty defensive, but taking profits is kind of one of the keys to being a successful scalper, because you can't control the losses so much, but you can control the profits because you get to make that decision. So I think that that's the cool thing, the key. Maybe at some point we will do another segment on that. We can definitely put it together. I've been promising to do it for years. It's probably time.
All right, great. There you go. Thanks, Jessica, for the nudge. Next up, general rule of thumb for amount of credit you should look for when selling an iron condor. Was it 30% of either the width of the wings or 30% of the max loss? Can't remember. Also, do you have a similar credit percent target when selling strangles? I dabbled in them a little and was doing great selling corn futures, but got blown up by nat gas. I've been too afraid to sell strangles since, but might give them another try again soon. What do you think?
I think everybody gets blown up by natural gas because it's it's hard to get blown up by corn because it doesn't move around that much. It's easy to get blown up by natural gas because, it's had 30% moves in a day and 20% moves in a day. I actually have positions on right now, strangles in corn and natural gas, and I feel like I want to see at the end of the year if I'm up or down money in corn, because all I feel like I do is adjust positions and nothing ever happens. Natural gas, on the other hand, it's much different. But anyway, to answer your question, the general rule of thumb you'd look to collect when selling an iron condor, it's based on what percentage you're looking for as your probability of profit. So if you collect 40, because remember, since it's a defined risk trade, whatever you collect divided by the width of the strikes is your probability of profit. So you never want to collect more than 50% because of that, then you have less than a 50% chance of success. Ideally, you'd like to collect somewhere between 35 and 40% of the width of the strikes. So for example, if it's $5 wide strikes, you'd like to collect $2. That gives you a 60% probability of profit. And that's not like some arbitrary or some subjective number. That's the actual theoretical probability of profit on that trade when you make that trade, assuming that you do it somewhere close to mid-price. So if you collect, a little less than $2, then your probability of profit goes a little bit higher. You collect $1.80, then your probability of profit goes up to, 65%. And so that's kind of how you have to think about iron condors. I would say you want to collect about between 30 and 40% of the width of the strikes. Enough that you can make money and not too much so that you don't have probability in your favor. Scott?
Yeah, no, I agree. It's the key, it's going to depend on, what your strikes are, obviously how wide, but it's exactly right. You want to just make sure that your probability of profit reflects, what you're trying to accomplish. So typically people are going to put iron condors out further. You don't want to be too close to the money. And, as your point, if you can collect $2, if you can collect $1.50, it just depends on where you are, but then you got to manage accordingly. So if you're putting it on, you got to be reasonable with your expectations on what the return's going to be. And if it gets there sooner than you are expecting it, take it off. And, we're talking about scalping. Taking profits becomes a challenge, for a lot of people.
It says here also that is a similar credit target when you're selling strangles. Not really. Strangles is more delta based. So you got to pick your delta and then you have to decide. In strangles, you got to be very careful because you need high implied volatility rank. So high implied volatility rank, get to the correct delta, sell it, move on.
And the problem with strangles, just to be clear, you need to be quicker on the trigger for adjusting. They're not defined risk, so.
But they're easier to adjust.
What's that?
They're easier to adjust.
They're easier to adjust, but you need to be quicker to adjust because things can go south quickly with strangles because you're naked.
Okay, there you go. Andy in the dog pound asks, there is a gap down on ES at 62.22. What would it take for market to drop here?
150 points.
There's a gap down to 62.22. That's actually 550 points lower than
62. Sorry, 500 points. I apologize.
So,
I was thinking 65. I'm sorry.
Yeah. 66. So you're talking about
big move.
It's fun. Yeah, we posted the questions now from the dog pound on the screen, which is fun. But you're talking about 550 point move. So let's talk percentages for a second. The index is, let's say, just under 7,000, 550 point move. You're talking about 7+% move in the stock market. That does not happen very often in the S&Ps. It's happened less than, I would say, I'm just guessing right now, but I think it's happened less than 6 or 7 times in 40 years, that kind of a move. So intraday. So that's not realistic. What would it take from here? I mean, it would take either some kind of an historic failure by a major U.S. company that would be completely unexpected. Which I can't even imagine what that is right off the top of hand, but some company that would take down an entire industry. Like something like NVIDIA saying, we're not even going to meet half of our numbers for the next year. And then the entire AI and NASDAQ space, goes down by 10%, that kind of move. Or it could take, which is much more likely to do something like that, would be an incredibly stupid, decision by some politician with respect to...
For context, I guess, for us, the question was that he's looking at charts.
Yeah, I understand.
Oh, okay.
He thinks there's a gap there.
Down. So he's saying you're filling it's in a chart.
Yeah, I mean, it's a typical technician thing.
I'm actually really happy to hear that you say geopolitical something could be on the table, because typically you're one that says geopolitical doesn't matter.
I don't think geopolitical would be the thing that could move it down there, but somebody could do, this current administration scares me because they're capable of doing something incredibly stupid, but because I don't ever think they have a plan. But I just don't think it'd be that. I think it'd be something like NVIDIA missing and taking down,
I will say that there is always, and I assume when you're saying intraday, there's maybe been 7 times where we're down that, but we could drift down there.
Oh yeah, we could drift down. I'm talking about intraday.
Yeah, you could drift down. It's just not a gap like where all of a sudden there's bad news, and that would require some significant shock. But there is always a reason for a down move. There's never a reason for an up move, because you don't need one, because people are like, oh wow, we just go up every day, so that's what we should be doing. There is always a reason for a down move. And typically, if you go back to 08 or 09, people are like, wow, I didn't know that lending money to people to buy a home with 0% down was ultimately going to cause a problem in the housing market, which ultimately took down the economy. And I'm not saying that that's where we are right now. I don't think structurally we're nearly in that same position, but I do believe that we are going to have a pullback, and I do believe that it's going to be something that we're probably not even aware of right now. And I don't think it's going to be from a company. I don't think it's going to be the NVIDIA missing. I think it's going to be somebody making a poor decision.
Okay, very possible.
Yeah.
Okay, next up. How to fix salary gap from CEOs to secretaries. The salary ratio is staggering. Is the free market able to regulate itself in the corporate environment? What is the best approach to solve this? Do we need oversight or mass revolt? Says Merrick.
Hopefully not either.
Yeah.
I mean, mass revolt seems a lot lot more plausible to me than oversight. I don't think you're going to get oversight. The salary gap is something that at Lossdog we're focused on to address it. I don't know anybody else that's trying to address this quantitatively. We're trying to do it at Lossdog with the new technology that we built. We actually built a piece of technology on the platform that shows the ratio between CEO salaries to the average employee. We have a whole section on that, so you can look up any company in the S&P 500, and you can see the ratio of CEO pay to the average employee. And you can see how out of whack every single thing is. It's not CEOs to secretaries, it's CEOs to every regular employee of every S&P company. It's gotten to the point where it's beyond ridiculous. I mean, you have some companies, I think it's like Citigroup, where it's 450 to 1. I mean, there's other companies that are...
Starbucks was 6,000,
Was it 6,000? Yeah. I don't know. But I mean, there's so many companies in the hundreds. I didn't even know there was companies in the thousands. What's a realistic ratio of CEOs to the average employee? I don't know, somewhere between 4 to 1 to 20 to 1 maybe. And yet every single company seems to be at 1, 2, 3, or 400 to 1. It's beyond ridiculous. And let me tell you something. As somebody that's been a CEO of a public company, and somebody that has also dealt with the CEOs of a gazillion different public companies throughout my career, I mean, I've been lucky to, there's not that much difference between the average employee and the CEO. I mean, I know it's easy to sit here and say, but I can easily see the average CEO of a Fortune 500 or an S&P 500 company also being a regular laborer at that company and not thinking there's anything special about that person.
Yeah, but the difference is because they become entitled, and then they
Well, of course.
convince the comp committee that they're worth it. I'm not coming unless I get this, and oh, we need that guy, so we have to pay him. I mean, you can make an analogy. Look at the numbers that these free agents are getting in sports today.
Different, much different in sports, in my opinion, because it's actually
go ahead.
Because it's a free market, and you have a very short lifespan, and a lot of these guys, you're looking at some of the players that make a ton of money, and there's other players that get cut, they get nothing, and you have a very short lifespan. I don't think it's the same thing in sports.
But it's similar. You're saying, what's the average life expectancy of a CEO on the S&P 500?
7 years. Yeah.
Okay, so it's limited, and they're going to come in and say, here's why you need me, because I did all this over here, so I can do the same thing for your company. What the Dolphins just signed, I'm saying, is it Malik Willis from Green Bay for like $60 million for 3 years? They're going, it's a steal, $20 million to steal. Think about 20 years ago. What was it? What was a steal in free agency? So people will pay what they think. I'm not saying that what they are worth, but people will pay what they think somebody is worth. Is there tremendous disparity? Yes. Does it need to be attacked? Yes. But I don't know that we're ever going back to 4 or 5 to 1.
I will tell you this. We addressed it on Lossdog with our technology by focusing on one thing. We're going to show people what they're worth, and most people are worth more than they're getting paid. And we're going to show you how overpaid most CEOs are. So you're going to see that most CEOs are overpaid by around 50% according to our calculations. So they're overpaid by about $55 million over the course of their careers. Most CEOs over their 7-year career, most at a $21 million a year in salary, they're overpaid by about 50% in that neighborhood, 40 to 60. Most employees are underpaid by millions of dollars, and that was the whole genesis behind building this platform. So let's see how much impact it has. If you teach people and you give them numbers and through education, I think you can narrow the gap.
Joseph
I agree, but I just want to make one last comment to say no to oversight. Oversight will never work, and hopefully no to a mass revolt, because that will not end well. But let's
I love a good mass revolt.
You love it?
Oh yeah. How do you change things without a mass revolt?
All right, fair.
Joseph in the dog pound says, but with AI replacing jobs en masse, is now a good time to try to negotiate a salary?
Well, that's something, Joseph, that you have to decide based on whatever you think your position of leverage is. I can tell you, again, I feel very strongly about, the idea that it's extremely expensive to let somebody go and on just for ego or something like that, and try to retrain somebody else if that person is valuable. So I feel like I can speak for ourselves, and we're very reasonable with people that we think are also very reasonable. I think there's no reasonable discussion gets unheard, or at least not addressed. I mean, there's different things with companies. If a company's having a hard time, they're going to be in a tough position to make adjustments, but they can maybe do something later on if things turn around. I mean, there's a lot of different things, but I think it's always a good time to have that discussion, as long as you are being reasonable about it. I think companies will be reasonable about it too, because they don't like to make change.
And I think the key there is being heard. So self-advocating, is critical. And chances are, if you're not, standing up for yourself and saying, here's why, to Tom's point, being reasonable, but if you're not doing it, it's probably not going to happen. I mean, unless the company's just crushing it and they're going to say, hey, we're just giving everybody some extra money this year. But, being in front of your manager, explaining why, not on a daily basis, because that becomes annoying, and that's not being reasonable. But if you think that you have value that is not being seen, or correctly, you're not being correctly compensated for it, stand up and say something.
Yeah, for sure. Absolutely.
Okay. All right, next up. Given market changes since the beginning of the Federal Reserve, do you think it is still a required institution today? Says our friend Mike.
So, Mike, I feel this is an interesting topic because we've debated this much in the past. The Federal Reserve exists, in my opinion, for one reason. It's catastrophic insurance, and their role, that's essentially their role. I think if you're talking about setting interest rates, the marketplace now is too big, and the Federal Reserve just plays catch up to whatever the current market is. So if bonds go higher, the Federal Reserve will lower interest rates. If bonds go lower, the Federal Reserve will raise rates. They have to reflect whatever the market is telling them. They don't have a choice. That said, I think it's really important to note there are times in our history, specifically last time was 2008, 2009, but there's also times like in the pandemic, and there's been plenty of situations along the way where the Federal Reserve has to step in, and because they're supposed to be an independent organization, they need to step in and they need to provide catastrophic or disaster insurance. And I think that that's a stabilizing force, and for that reason, I would argue that the Federal Reserve is necessary because there are certain situations when they need to step up, when different branches of the government can't get their act together. And certain things are happening in the marketplace that need to be addressed. So I would say the Federal Reserve is a required institution today, but we can't let it be politicized.
Yeah.
My question for you on that is if you're saying that the marketplace could handle rate changes, how? Because right now...
What do you mean, how? It does it every single day. The marketplace is the rate change.
No. I get that the marketplace is going to say, here's where the rates are. But if the Fed sets, effective Fed funds, they set the Fed funds rate. So if that goes away, so right now...
Oh, I'm not suggesting it goes away. I'm just suggesting that's something that can be done.
Got it.
Like,
okay.
I don't think
you need that. To me, that's a very, very important role because it brings stability to the marketplace.
Yeah, sure. I'm fine with that. Yeah, okay. I don't want the executive branch setting interest rates, but the marketplace does a really good job of telling the Fed exactly what the rates need, where the rates should be. So I don't think that's their main job.
Okay. Next up, I've been selling 20 Delta 45 days to expiration SPX iron condors with $20 wings pretty regularly. Really, Delta is 19 to 22, but I try to keep it close to 20. Excuse me. I noticed in order to keep my Delta neutral, the sell put legs is much further away than the call sell leg. I've been staying very mechanical following the 20 Delta 45 days to expiration strategy, but it seems like I could tighten up the put side to earn more premium. Do you ever skew your iron condors by keeping the sell legs evenly spaced, or do you always remain Delta neutral with iron condors?
No, of course. We skew them all the time. If you want to move the put side closer, go ahead. I mean, that's just skew. So, you're going to collect a lot less money on the put side if you keep the deltas the exact same. So you might as well move them up if you're, unless you're bearish. But if you're neutral to a little bit bullish, sure, move up your put legs and collect a little bit more premium so that you're like premium neutral. You won't be exactly delta neutral, you'll be a little bit long, but who cares? It's an iron condor. And we skew our legs all the time. I mean, that's really natural, by the way, is to start where you have delta neutral on both sides, then move, either move your call side down or your put side up, whatever you want to do. And I think that's completely normal. Move your call side up and your put side up a little bit. Give yourself a little upside skew. It's up to you. A lot depends on where the market is. If we think the market's overbought, we give ourselves a little short delta. If we think the market's a little oversold, we give ourselves a little long delta. But yeah, I mean, that's the beauty of today's technology. Do whatever the hell you want.
And these are guidelines.
Yeah, they're guidelines.
These are not hard and fast rules that say this is what you have to do. Try it. This is a starting point.
Yeah.
So start, to Tom's point, start, delta neutral, and then all of a sudden you say, you know what? I want to move this one or move
tweak
this one.
Tweak them, baby. That's it.
Go do it. Tweak them. Go ahead. Make the adjustments. So again, starting point, not hard and fast set rules.
Okay, great. Our friend Chestnut in the Dog Pound says, Tom, what other contrarians do you enjoy listening to?
Are there other contrarians?
Tom and my son are elite contrarians.
I mean,
funny.
Here's the funny thing, Cesare. there are
That's
like
good.
a crazy number of contrarians in everything that in your life except markets that I found. Like in other words, like if you go like in sports, everybody's a contrarian. You know, like everybody will take the other side of anything. But when it comes to markets, there are so few like really pure contrarians. Now there's a lot of like traders that you don't know, like friends of mine and Scott's and the whole world of traders, they're all contrarians. And there's no trend trader, I've never met one in my life. Every single person's used to taking the other side of every trade, so they're pure contrarians. So I would say that in the trading world, everybody's a contrarian, but do I listen to? Man, I don't listen to, let me think about this for a second. Who's a contrarian out there that I listen to? And I don't know that, I don't know, Scott. Do you know anybody?
I don't, and
It's crazy. I can't, I've been stumped on that question. I don't know. I don't listen to anybody.
There's nobody that you listen to, period, ever. So you're doing
Yeah, I'm not a
whatever.
good listener.
No, you are not a good listener. So,
Can you say that again?
but I don't think listen, you have definitely met trend traders.
Oh, I
You-
met a ton of them, but I'm just talking about, he asked about contrarians. I don't.
Right,
you know.
right. So, no, it is a good question. Nobody is jumping to mind right now.
Yeah, sorry, man.
It's a good question, though.
Okay, next up. Does a poor man covered put call double diagonal outperform a naked straddle from ROC perspective over time? Mike.
Mike, what kind of question is that? Does a poor man covered call double diagonal
Call double diagonal.
outperform a naked straddle over time from a return on capital perspective over time? I have no idea.
I don't either. I'm going to say no, but it's
I'm going to say no
possible-
too.
But it's possible that you got some blow-ups that take down the return on the naked straddle. But there's so much more risk in a naked straddle than there is to doing the poor man's covered put call double diagonal. That's a mouthful.
Yeah.
Good question.
I don't know that I've ever done a poor man. That means you're buying the poor man double diagonal in this case is you're buying a back month strangle, you're selling a front month strangle, and the back month strangle is way back in this case because that's why it's called a poor man's covered. And so so you're buying a back month strangle, you're selling a front month strangle. That's your poor man's double diagonal, and does it outperform a? I mean, I would say no, but
Me too.
you take a lot more
It's
risk.
going to come down to how volatile the stock is and do you have any blow-ups on the naked? Because otherwise
Yeah.
it has to unless you have blow-ups.
Well, you're going to take more risk with the naked straddle for sure.
Yeah, of course. A lot more risk.
Yeah, don't be shy, everybody. I don't know what's going on with you guys today,
Yeah,
but
call us. 989 Lossdog.
yeah, Saul's going to get a little shaky here if you don't call
I'm
in.
going to get bored. Come on. Give us a call.
She's got to talk to me all day long.
Yeah.
Drives her crazy.
Okay. What do your stops and targets look like when going for a future scalp? I hear it's a cardinal sin, but will you move either depending on the action? Says Matt.
That's a good question, Matt. First of all, we don't use stops, but like mental maybe, but not hard. The target for me depends on what's happening that day. So on a day like today, you know, my targets might be on a future scalp might be 10 to 20 handles. On a day with less volatility, I'm thinking it may be closer to 5 to 10 handles. But a day like today, I'd be thinking 10 to 20 handles, and that's what kind of my targets look like on a future scalp. If you're talking like S&Ps, if you're talking something like crude oil, it would be like $1 to $3 in this market here. If you're talking on something like gold, it'd be $5 to $10. On silver, maybe $1-ish. But that's kind of where I would be on a day like today. My stops are much more subjective and less relevant, again, because I think that when you're scalping, your profit targets are what's important, not your loss. And the reason I say that is because you can control your profits. You can't really control the loss as much. So that's kind of where I'd be. I don't know that it's a cardinal sin that you move either depending on action. I don't use stops, so I don't like move them up and down, or like I don't have a hard stop. I just, I'm a junkie. I sit in front of my screen all day and just make adjustments based on what's happening, I guess. But I usually, you know what? The more I think about this, I don't really adjust. Once I have a profit target in mind, I just take it. I don't know about you, Scott. I don't move that much.
I agree with your numbers, and it depends on how things are moving. I mean, the S&Ps today, they were up a few dollars this morning. They sold off 30. Now they're unchanged. So you just had a huge range in there, which speaks to your 10 to 20. Potential.
Yeah, while we've been talking, they've had a 30 handle range in the last 15 minutes, and
Yeah, that's what I'm saying. So the 10 to 20 point scalp is right there. Matt, I would only say your scalps, and again, it depends on your time frame. So is this, are you looking for a couple hours? Are you looking for the day? Are you looking for a day or two? Because it just depends on what your scalping time frame is. But if you have something going in your favor, and I don't use stops like as Tom is saying, I don't either. I'm just watching all day, and I will have a mental, but I'm not going to put one in during the day. But if you can't watch the screen, there's nothing wrong with if you have, let's say, a trade's going your way and you think for whatever reason it's going to continue. There's nothing wrong with adjusting your stop at that point and say, okay, I'm going to let it keep going. I'm just going to move the stop. But if you have a profit target in mind, typically I'm going to say take your profit and move on to the next trade.
Okay. Andy in the dog pound says, bad news and wars seem to only start on the weekend when markets are closed. I am worried about holding trades over the weekend at this time. Is selling weeklies, credit spreads better in this climate?
I mean, I can understand, Andy, a lot of people are nervous about going into the weekends with naked positions. I made that horrible mistake last weekend. And it was a lot of work yesterday to get back to even. Lucky thing we had a sell-off in crude oil. A nice one too, $30 yesterday.
Yeah,
but
you can't count on a $30 sell-off.
Yeah, you can't count on a $30 sell-off in crude oil every weekend on the following day. I completely understand. There's been times when we've been in like situations like we're in now. Thinking back into 2020 and stuff like that, where the overnight moves were 70% of all the tape action, and weekend moves were crazy. That's originally why we started doing a show on Sunday night, is because the weekend moves were as big as any moves we had during the week. And so, sure, I hear you. I don't change my trading. I'm not. I don't think I'm disciplined enough to think about things like different from intra-week to over the weekend. So I kind of keep my same positions on, and I don't really adjust. If you feel uncomfortable at all, which I completely understand, sure, do the credit spreads instead. At least it'll give you peace of mind.
100% agree. And this all comes down to being engaged, but you have to be comfortable with your engagement. So if your choice is, well, I'm just going to stop trading because I'm worried about the weekend, versus I'm just going to stay with weeklies, flatten my position, not have anything, 100%. Move to the weeklies and don't carry anything, or reduce your risk over the weekend. The good news during the week, things are open. So, we're closed for an hour for futures, but besides that, and stocks are trading. So you could make adjustments, not in the options world, those aren't trading, but you could trade, you could adjust with some futures, and you could adjust your stocks, the outrights, the underlyings if you want. But do what makes you feel comfortable. If you're uncomfortable with anything, regardless of what it is, meaning time or product or strategy, change it.
Yeah. Okay. Let's take a call. Jeff from Ohio. Hi, Jeff.
Hey, Jeff.
Hey, so how are you and Tom and Scott? How are you monkeys holding up?
We're all good.
We're still here, Jeff. That's all that matters. We're still here.
All right, man. Tom, I talked to you April 7th of last year, and I told you I went long that day that we printed 48.34, something like that. And I went long the market, the SPX with the product XSP.
Okay.
And I rode that thing for 1,500 SPX points.
We're gonna put up the ice statue of you right out in front right now. How big a block of ice do I have to buy, Jeff?
I chickened out and bailed it up around 6,400.
Oh, you pussy.
And, I know it. But that was a kind of a contrary trade at the time, if you remember.
I kind of remember,
It was,
yeah. I remember the conversation we
yeah.
had. Yeah, I remember the conversation.
So, and then I had to laugh because yesterday while you were talking, we were tickling 6,666 points on the SPX. And so I actually went long yesterday, and then that's working out okay today.
Yeah, sure is. Nice trade.
So those are all contrary type trades. But
Yeah, you're a buy
you
the
guys
dipper.
took me
You're a buy
down
the dipper.
Yeah, I'm a dipper. But no, I've shorted it. It was pretty high a while back, and I shorted the heck out of it, and it worked out pretty good too. But I just been playing Ram Bam,
I like it.
up and down.
I like it.
Yeah, man. And so, do you remember what was going on the day the market printed 666?
You mean on March
That was,
9th of 2009?
Yeah, it was when we were in Chicago at the advanced options class, and you came in without a beret on, and that's the first time I saw you.
Was that March 9th? You're talking about March 9th or March 10th of 2009?
Yeah, March 9th, yeah. Bobby Lee and I were in class with you in Chicago, and that's the day it printed 666. And who else? Steve R. taught us how to trade calendars, and
It figures. With the market crashing at all-time lows, Steve R. would teach you how to trade a calendar spread. Only him.
And then Tim,
nice.
Tim, the technician guy, he was buying the hell out of SDSs.
Well, I can tell you
Or
one
he
thing.
had.
I can tell you one thing. March 9th, 2009, we were long because the Russell that day also traded, I think, 334, and I was long that, but we were long at such crappy ass prices. Like I had started to get long in December when the VIX topped out at like 87, 88, and then by March, the VIX was already down to like 50 something. But the market hadn't bottomed. That was the weirdest move because the VIX topped out in Dece. The market didn't bottom till March, and but we were long for those 3 months, and it was awfully painful. And then we started to get our money back starting after March 9th. That's why I remember all that.
Yeah. And then TP came in, and he looked like Charles Manson's brother back then.
Well, he is Charles
He had a
Manson's
bunch
brother
of-
technically. I mean, he still is. Yeah, he hasn't changed.
He had a whole bunch of hair, and it looked like Crazy Man walking in there.
Yeah, he should be incarcerated somewhere, but we don't know where.
But Sol, I didn't get to meet you that day, but I think you might have met Bobby Lee when you got back to the office.
Yes, Bobby Lee.
Yep, and Bobby and I were trading partners, and I sure miss him. He was a great guy.
Yes.
Everybody comes back. It's just
Everyone.
It's a small world. All right, Jeff,
Yeah,
man,
so
good, great.
It was fun going down memory lane with you.
Yeah, that was great.
Last week with the monkeys, and the monkeys are gone, but I still have my Roku and 2 books from
nice.
Tim Knight.
There you go, dude. There you go.
All right,
All right, man.
Hey, great
Take
job.
care.
You guys-
Take care,
yeah,
Jeff.
Good luck. Good luck.
Thanks, man.
Thank you.
Thanks,
Have a
Jeff.
great day.
My God, it's really scary that I'm sitting here remembering March 9th of 2000.
It's funny, I
2009.
remember exactly where I was. I was down in the office. I didn't remember the day.
I remember it like it was yesterday, March 9th, 2009.
I was in the office.
And let me tell you, the world was freaking scared. Like,
Yeah.
that was not, like, Jeff is joking about it and stuff, and me, we're all joking about it, but it was scary. I was worried about, you had, at that point, you had Merrill Lynch basically going out of business. You were worried about Goldman Sachs going out of business. Every major financial institution was on their butt.
Well, Lehman and Bear did.
Well, Lehman and Bear did. And we were, like the craziest thing is our firm was totally safe because of the nature of our customers and our business. But we were worried about clearing firms, counterparties, everything.
Yep.
It's crazy.
Yeah,
Crazy times.
it was scary.
All right, man. Let's go.
Next up.
That was good.
How do you anticipate 24/7 options markets will impact zero DTE trading? The idea behind the trades is to get in near market open while volatility is high and get out once it drops, but before the end of the day when it tends to spike. If the market is open 24/7, when will we get in and when will we get out?
Okay, I'm going to say, first of all, I didn't know that there was a cheat sheet for when vol was higher or lower during the day. We will be going to 24/7 options. It's going to happen. It's starting to, but there still has to be a day. There's always going to be a day. So regardless, there will be a day, a time, and you're going to say whether it's still going to stay 3 o'clock Central or whether it's going to shift. My guess is it stays 3 o'clock Central, because you need to end the day, you need to settle, you need to clear, and then you can start again. But I wouldn't worry about it at all. I think it's just going to be a natural transition.
Yeah, don't overthink this at all. We already are trading 24/7. Most of the markets are open around the globe, even SPX markets. ES markets trade 24/5.
SPX is not really available for retail yet, but it's getting very close.
Yeah, well, it's not, but ES markets are available retail, and they're open 24/5 already. Markets are open around the clock, and you can trade in other countries. They have CFDs that trade, basically 24, they trade 24/7. Our markets trade in the US 24/5, and stocks now are 24/5. So we're already there, and it hasn't changed a single thing. So don't even worry about this. You're overthinking it. Don't worry about it at all. The day is still going to be the same day. Just as crazy as it ever was.
Yep.
All right. What is the most important question to ask yourself when purchasing Bitcoin? Says Mary Jo.
Mary Jo, how much money do you want to put aside and not look at it again for a long time? Because Bitcoin is what we call dead money. It's very passive money. And when you buy Bitcoin, you're buying I would say a technology asset that you plan to hold for quite some time, or maybe you set a price target. Like Bitcoin's, where is it right now? Wrapped around 70,000-ish? Yeah.
Yep.
70,000, just over 70,000. I mean, in your head, you could say, I want to sell it if it gets to 100. I want to sell it if it gets to 90 or whatever. I want to sell it if it gets to 120. Or you can say, I'm just going to wait and see what happens. But the bottom line when purchasing Bitcoin is it is a passive asset that you're just going to sit on. So it's how much money do you want to put into a passive investment? Just think of it like that. I have no issue with anybody buying as much Bitcoin as they want to, or anybody buying as many digital assets as they want to. But just remember, you can't borrow against it. It's pretty much dead money. So it's just passive, it sits there, and how much money do you want to put aside? That's how you decide. And if you want to go a step beyond that, just think, 1, 2, 3% of your liquid net worth. That's usually 5% max.
Okay.
You
Scott,
pick a
do you
number.
agree with that?
Yeah, I think it's good. I think the question is, to Tom's point, being dead money, you need to understand that. So what's the reason you're buying it? Why are you going in to buy it? Are you buying it because you think that, 70,000, you think it's a reasonable purchase? Not saying it can't go to 60 or 50. Are you buying it because your friends are buying it? Are you buying it because you believe, as Tom's saying, in technology, and you think this is a play for the long term?
I just buy it to own it. And so I'm buying it all over.
Have a reason to buy it, whatever the reason is. And then if you have exit targets and it hits there, get out.
I bought some at 80-something thousand.
Sure.
I bought something at 70-something thousand. I bought something at 60-something thousand recently. Yeah, I'm just buying it all the way down, and probably I'll sell it if it breaks up over 90 and something like that. I don't fall in love with this stuff. I just think it's cheap here.
There you go.
Maybe it's not. I don't know.
Okay. Let's take a call. Tyler from Chapel Hill. Hi, Tyler.
Hey, Tyler.
Hey, how are you guys?
Good.
Good. How you
What's up?
doing?
After I blew all my money on the strippers and hookers and all, and went to Vegas, I was wondering what jobs that AI was going to take a vacate on so I could get some of that money back.
What jobs are AI? Say that again. AI is going to help you with?
No, what jobs AI is going to hurt? Like what job group and like stuff like that you should stay away from coming up?
I mean, I don't know. Does anybody know that answer? I mean, I know that the conventional answer would be something in the engineering space, because AI's quicker at programming than we are as humans. But I question that, because what I'm seeing here with our own dev teams is that AI is not taking jobs away, it's actually adding jobs on the software engineering side. So, I mean, for us, I mean, it's different than what happened recently at Block and different what happened at, you know, Meta and things like that. But for us, how old are you? 20?
18.
18. Why the F are you worrying about that now? You go study whatever you want to study, and you worry about that like 5 years from now. You don't even know what you're going to do 5 years from now, you know? And so you got to...
I'm trying to figure it out, that's why.
No, don't try.
You're
money in
going to
Vegas,
figure it
please.
out.
You're going to
by
figure out 6 different things.
Enjoying your college experience.
Yeah.
You're
Yeah.
going to learn so much over the next few years. Some will be in the books, a lot won't be in the books. That's going to set you up way better for success than freaking out about
100%.
right now. Where do I have to be in 4 years? Don't figure out a target point. Just create a great base.
Yeah.
And you create a base by meeting people, by learning what's in the books.
Learn
by
as
learning
much stuff as you
non-book.
can. Just take as much stuff as you can. Figure out what you like. Maybe you want to be a film producer. Maybe you want to be, I don't know, you know, maybe you want to be a historian. Maybe you want to be an engineer. Maybe you want to be a data scientist or a statistician. I don't know. But whatever it is, just take whatever you want. Make sure you mix in a lot of math though, just because you lead that, and just figure it out. You know, you got 4 or 5 years.
Yeah.
Well, if you blew all your money in Vegas, then you've only got probably 4 years, because you're not gonna have any extra money to go a 5th year. But
Yeah, I'm not going to have any extra money for that 5th year.
yeah, that's right. So you got to do it in 4 years. But you're at a great school. Get it done, dude. Man, just do everything. Just take as much as you can. Suck it all up.
Well, thank you.
All right, man. Take care.
Great advice.
Yeah.
You too.
Okay, next up. How does MSTR get away with such a scam?
How do they?
How
Do they? It's a good question.
I saw Jeff was reading me an article this morning, or showing me an article this morning, not reading to me, showing me an article this morning where they raised something like $350 million or $380 million last week, which I shocked, at 11.5% interest they're paying, and of which they turned around and went out and bought Bitcoin with. And my thought is, like, who would lend money? Like, I'm trying to get it through my head. Why would you lend money to somebody at 11.5%? Now, just remember, if you're getting 11.5% on your money, you're getting that because you're taking a lot of risk. Like, you're taking 3 times. Here, he bought they raised $382 million and bought $1.2 billion worth of Bitcoin. I'm not sure how those numbers work, but those were the numbers. And I'm thinking to myself, okay, you're paying 11.5% interest, right? If Bitcoin doesn't go higher, you're going to just lose your principal. And I'm bullish on Bitcoin, so like for myself, so I understand it. But if Bitcoin doesn't go higher, that 11.5%, not only do not get the 11.5%, you don't get your principal back. I just don't get it.
You don't know the terms of the deal, but
What do you mean the terms of the deal? It's a straight loan type. I mean, it's a straight debt. 11.5%.
If you're bullish, just go buy Bitcoin yourself. What do you need them for?
Well, because it's 11.5%. You don't have to buy Bitcoin in this case. It's 11.5%, and you're betting that Bitcoin's.
You're in complete control.
But you're betting that Bitcoin's not going to go lower. I know why people do it. If they're bullish on Bitcoin at all, or they're bullish on digital assets, they're like, listen, I can't get any money for the Bitcoin, so I'd rather just bet that the principal stays here and get 11.5%. But I'm saying, I mean, I would never do that as an investment, but somebody did. 383 million did. I just don't get it. So
Yeah.
is MSTR how do you get away with it? Well, I mean,
there's people out there willing to take the risk. They don't see, problem. There's people out there willing to sell nickel options, which, to open, which you would never do. So, people are looking at, part of the problem, I think, is that it's not their money, it's a fund, and they're chasing returns. So they go, wow, I can get 11%. And if it goes south, you just blame it on MSTR, and people will be like, oh, it wasn't my problem. I put your money into a great spot. MSTR messed up. So,
well, I also think that if you're managing a fund, and you can get 11.5%, it keeps your job. It keeps your job in good standing.
But it's not your money. Chances are it's not their money that they're doing.
No, I completely understand. If it was their money, they would never do it. Like, that's the whole thing with this. Of the $383 million, none of it's the person's. None of it is the money. That money is not. None of it's the individual's money.
Putting the $380 million in.
Yes, it's other people's money. So just going for the 11.5%.
OPM.
I mean, 11.5%. You're taking 3 times the amount of risk of risk-free. That's all it is. So
there you go.
You got a 35 to 40% chance of getting your principal back. But I guess if it's not your money, what do you care?
Don't scare the children.
Yeah.
Yeah.
It is scary.
Stupid ass people. I would fire my money manager. That's all I can tell you. But most people have no idea what they're investing in.
Correct. They give it to a fund, and the fund's like, hey, here are our returns. This is what we can do. You're going, great, here it is. And then if you find out that you're lending money.
So then Michael Saylor is either a scammer or he's a genius, because he's figured out that there's a loophole out there which says that money managers would rather, don't really care. They just want the 11.5%. They don't even care what the investment's in.
Correct. Boom.
Ay. Okay, with many countries selling the U.S. debt they hold and no plans to buy more, along with the Fed adding to the money supply, plus the lack of lower wage foreign workers in the U.S., a surplus of soybeans, corn, and wheat, and inflation running higher than reported, do you see a recession or depression in the U.S. this year?
Thank you for the easy question, Hugh.
Yeah.
I mean, nothing like Scott and I sitting here with the 2 worst macro people in the free frickin' world to talk about. I mean, the funny thing about U.S. debt is that it's been surprisingly, the debt markets have been surprisingly strong, along with the strong U.S. dollar recently. So you have a strong U.S. dollar, you have a very strong U.S. debt markets. They've been. I'm not sure where bonds are today. Let's take a quick little look.
Bonds are up 4 ticks, 116.12.
Yeah, 116.12. So it's like they're right in the middle of the range, higher, a little bit higher into the range. We haven't had a real recession. Well, we're not going to have a depression. I always feel like the U.S., you can't bet on a depression ever. You can't bet on depression.
There's too many tools for the Fed.
Yeah. You can never bet on depression. You want to talk about a recession and whether or not a recession, a little inflation is healthy. I argue that a little inflation is healthy. It's possible you see a recession. I think, you are going to see a lower market by the end of the year, but this market continues to be incredibly resilient. And while other countries are selling U.S. debt, somebody's buying it. Somebody's been buying it. It's bid.
Yeah. It's bid.
Yeah.
So,
and I'm not sure that we're going to see a recession, but there's a much better chance of that. I don't think there's any chance of a depression this year.
Completely agree.
Especially not with midterm elections and everything else. I just don't see it happening. And not with the Fed, whatever, they're leaning towards lowering rates, not raising them.
Okay. We'll see. I have made more money lately on long straddles on gold and silver versus short. It's working.
There you go, dude.
Says Steven.
Every once in a while, you got to do what's working. I have not made any money on short strangles or short straddles in gold and silver, so it makes sense that you've been making money there. Sometimes you catch, sometimes you catch that wave, and you got to remember that long straddles and long premium in many cases will work 20% of the time. I mean, it's just a mathematical, you're going to get 15, 20, 25% of the time. Being long premium versus being short premium is going to work on a short-term basis and a medium, intermediate term basis and on a long-term basis. And this has been, in this particular product, one of those times. So I think that, listen, you read the room.
Yeah, just be careful. You don't want to be the last person standing in the room when the music stops when you're long premium.
Yeah. But you obviously are clear of the concept.
It's great.
But yeah,
again, if it works, keep doing it.
Yeah, you read the room, you nailed it. Congratulations, good trade.
Very good trade.
Yeah, I don't flip the cards that well. You flip the cards.
Yeah.
All right. Should go to market talk. Or are you going to do one more?
Let's do one more.
Okay. Do you have any tricks on how to tell where the market maker will fill you? Mid-price is useless when there are no orders on the chain. How does the market maker decide where to fill an order, and is that level available via any tools that you know of?
Okay.
Scott?
Yeah, well, first of all, I'm assuming when they're saying no orders on the chain, mean they're looking like in an order book where somebody's trying to do a trade that they're trying to do. But that, forget all that. Market makers want to trade. Market makers will trade anything if they think that they have appropriate edge. So midpoint is what we use for spreads just because it's a good starting point. Now, if you're trading something that's really liquid, you should be really close to your midpoint, penny, 2, 3 pennies, off the mid, depending on if you're doing singles or if you're doing spreads. The more legs in the spread, so the less delta, the closer you should be to the mid, because there's less risk for the market maker. Remember, the market maker's got to hedge whatever the trade is. So if you're coming in just buying calls or buying puts or selling puts or calls, they've got to do stock to offset that, or futures. If you're coming in to do an iron condor, they might just put that in their position and not touch it. So they're going to probably be more likely to get close. What I always like to do, if you're doing more than one contract, if you're doing one contract, start either, if you're selling, start at the mid and work your way down. If you're buying, start at the mid and work your way up. If you're doing more than one contract, do price discovery. So if you're doing, 5 lot or a 10 lot, don't just put a 5 or a 10 lot in, put a 1 lot in. Put a 1 lot in, see if you get filled. And if you do get filled there, back it off. Say, I'm going to be a little more aggressive. I'm going to pay a little less, or sell it, try to sell a little bit higher. But the market, forget whatever book you're looking at, whatever spread book you're looking at. Market makers they want to trade. Market makers only eat if they're filling orders and they're making money on the trade. So just be careful when you're putting it in. Don't just say, well, I'm going to go a nickel below or a nickel above, because it depends on the product you're trading.
Yeah, I think his question's a little different, and I'll give you an example. Yesterday, when oil was going crazy in the afternoon, I had a position on, and I wanted to roll up some puts, and the market on the puts that I'm short was no bid at $5, and it was one of the most popular contracts. And
It's
it was
a good market.
It was literally no bid. It was 0 bid at $5. And I looked up and down because the market was kind of crazy because oil had just dropped $30. And on Sunday night when oil opened up like $20, the markets were $5 wide as well. So there are times when you're going to look at these markets and they're untradeable. And now today the market's 4 cents wide, which is where it should be. But yesterday, in a crazy point during the day, the market makers had just stepped away, and the markets were $5 wide. Those markets are they're useless. Mid-price is useless. Those markets are untradeable. And when there's no orders on the book and market makers have stepped away, there's no way that anybody can decide where, you could try a 1 lot and mix it around whatever you think mid-price is and try it. But there are a few times, it's really rare, and especially rare in a liquid underlying like crude oil or S&Ps, but there are times when the markets do get untradeable. It sucks, and it scares the crap out of every one of us. It doesn't happen as much in equities as it does in futures options, especially at night. Futures options can get really thin because market makers step away. But during the day, in most equities and most futures options, that never happens. But it did happen yesterday. So this email probably came in yesterday, and it did happen. And there was a time yesterday afternoon when you could not trade crude oil options. The markets were $5 wide and untradeable. So I hear you. There is no tool. There is no answer, and it just happens. You got to take a step back.
Okay. Market talk. Let's do this.
Bitcoin catching a little bit of a bid while we've been talking up 71.5. Oil down $10. Now, again, that's not really, I think, where did oil really close at 3 o'clock?
Where's it trading right now?
Like
What's the price?
$84, wasn't it like 86, 87?
Yeah, it traded up to 90 this morning, but yeah, 80.
It's 84.23 right now. SPOs are up 28 at 68.
Oil just is the inverse of the markets. Markets go up, oil goes down now. But who would have thought from Sunday night to yesterday you would have a 30 handle drop in crude oil? Now listen, I've been short crude oil because I thought that move was ridiculous, but I can tell you right now, I was getting 100 to 1 emails that told me I was crazy. Like, how could you sell it here? And because everybody thought it was a lock, it's going to 150, it's going to 100 and whatever. And like, sometimes you just got to be really careful. Don't fall into all the hype and all the bullshit. Every single headline I read yesterday that came across like on news was oil's exploding, as oil's crashing, as it's crashing.
Yeah.
It was funny. The news was saying oil's exploding. I'm like, guys, it was down on the day.
That's right. That's right.
Right.
Yeah. Nobody looks at price. I mean, wake up.
Yeah, gold's up 115 to 52.70.
Huge move in gold after it was really soft yesterday, very strong today. Silver's really strong.
Silver's strong. Silver's up almost $5, 89.5. Excuse me. NASDAQ is up 175,000 and change. Some big movers today. Google's up 3, Meta's up 11, Moo up 25. That stock is 415. I think it traded yesterday morning pre-market 360. 360, 365. It's 415 today.
That's going to hurt. That's going to leave a mark.
That's a big move. Nvidia's up $3. That's 85 and change. I think pre-market yesterday that might have been 174, 73. And it's now 185. So some, obviously some significant rallies. You got the VIX future down 114. You got VIX cash down 285. It's still 2265, but it's a big down move, down 10%.
Yeah. This is while we're talking today, the S&Ps have had a 60 handle rally off the lows.
Yep.
Just while we're doing this show, which is just basically a 1% move from bottom to top, and now they're kind of making their bed for the day. But since yesterday, the S&Ps have rallied almost 200 handles. Remember, we were like 200 handles lower. We were 666, and now we're
6,584.
Oh, 6,584. So now we're 34. We're 250 points higher than we were yesterday. So 250 points is just under 4% move in less than 3 hours. So that's why.
Well, it's not 3 hours. It's a day. It was Sunday. That was Sunday night to Tuesday morning.
Okay. Whatever the case.
It's a big move.
Yeah, it's a huge move, and so we're having some crazy volatility, having some fun with it. That's cool, and we're just looking forward to see what happens, play out the rest of the week.
Arthur says, what are we doing in Oracle into earnings? Get long after it got cut in half over 6 months?
I did get long Oracle this morning. It was down, when I came on the show, it was down $1.90. Where is it now, Scott? Oracle's
down 87 cents.
87 cents. I sold the 125 puts this morning, and I'm also short the 135 puts. So I'm short the 135 puts in April, and I'm short the 125 puts with 3 days to go in March. That's what I traded so far, Arthur, in Oracle. And trust me, I hate Oracle. I hate everything about Oracle.
What are there? $1.31, $1.50, $1.46, which is only like $1.40.
Which ones?
The ones I'm sorry, you said 3 days or 10
3
days?
days. At 75 cents.
Sorry.
I sold them at 75.
Yeah, they're 58.65.
I sold them at 75 and 74.
There you go.
And
Luther.
I don't know where my April options. I sold those. I've been in that position for like a week, so I'm not sure where. But yeah, Oracle's. I don't know. Like you said, it's cut in half. I'm just a contrarian.
There you go.
All right, please like this video and subscribe to our Lossdog YouTube channel. Email us your questions at oneluckydog@lossdog.com and /take us out.
Happy Tuesday.